Hi, this is Michael Chu of 7M Realty based in Silicon Valley and Fremont. Welcome to the monthly market report for February 2022. So let's cover some of the statistics on the market update for Silicon Valley. Here you'll see the Santa Clara County data from December 2021, and the next piece is home sales is at 741 units being transacted, but this one compared to last year is down by 17.2%. Active listing sitting at 204 for December. This is for the entire Santa Clara County, and percentage change from last year is down by 55.7%. So inventory is continuing to be restricted or be very small at this point. So median days on market is 8 days. That means as soon as it comes on market, most of these properties are being snatched up within a week. And sale to list price ratio is at 110%, which means it's a 10% overbidding to the sales price on average. And then of course number of active listings with reduced price. Surprisingly, there's a 12% number in here. So if we move on to others, we pick out one particular city down in Silicon Valley for Sunnyvale, and the numbers are even more staggering. Median price is $2.5 million, and compared to last year, it went up by 40%. So 45 homes were sold, a reduction of 21% from last year. 8 active listing, also reduction of close to 40%. Days on market is still about 8 days. That's pretty short. And then here, of course, is another rate, 124%, which means every home are being overbid by about a quarter of its list price, so 25% higher than it was listed for. That is a very staggering number to be looking at. And then we'll come to the Alameda County, where there's about 8.6% there. So moving on to Fremont. So the Fremont numbers are 87 in home sale, so that's down by 16.3%. So median price at $1.6 million is up about 27% from last year. Active listing 17 active listing, and market competition. So in Fremont, compared to the entire county of Alameda, we actually have only 8 days. So this is comparable to the Silicon Valley, Santa Clara County days on market number. So the sale to list price ratio at 110%, which means on average about 10% overbidding. But also surprisingly, there's 11.8% reduction. Well, there you have it. This is the December update. Hope this will be helpful, and we'll bring it to you every month with an update on this. We will see you next time and continue on with a more longer report on the market condition, all the things that you need to know about the interest rate, where the market is going, some of the predictions. I'll be walking you through 3 of the most important topics in the housing market right now. How home ownership can be a hedge against inflation, the rising mortgage rates, and the latest update on forbearance. And finally, help you draw your own conclusions based on the data presented. So let's begin with the first topic, home ownership as a hedge against inflation. Now, why is this important for us to be talking about? Well, as we see prices rise around us at the gas pump, grocery store, home ownership is certainly not immune to that in any way. And neither is rising rent. We'll be going through talking about that as well. But one of the things that we want to focus on is how locking in someone's fixed monthly cost, their biggest cost that they have in home ownership, at today's price is so beneficial to safeguarding someone's hedging against the rising costs around us going forward. So I want to begin with a quote from Investopedia. It says, real estate is one of the time-honored inflation hedges. It's a tangible asset, and those tend to hold their value when inflation reigns, unlike paper assets. More specifically, as prices rise, so do property values. So what we can see here is that home ownership is one of those things that you can lock in the cost today, and it's an asset that will increase in value in time. And as prices rise and home values rise, all the prices around us rise. You know, locking in that fixed cost in home ownership is really a game-changing as a hedge against inflation tomorrow. So what I want to do on this next slide is show you a visual that really depicts what we're talking about with home ownership outperforming inflation over time. Let's take a look at this slide here. This is home ownership as a hedge against inflation, and I want to break it down for you so you can really see what we're talking about here. This is home price appreciation versus the consumer price increases over the decade, and it goes all the way back to the 1970s. Now what you're looking at here is the blue bars are the average inflation rate for the decade, and the green bars are the average home price appreciation for each of those decades as well. Let's look at the late 1970s to start. Inflation increased at 7.1% in that decade, and home values appreciated at 9.9% in the same time period. So home ownership outperformed inflation, and where do you want to be in inflationary times? In that asset that outperforms inflation. Now in the 1980s, it was a little bit more balanced, 5.6% inflation, 5.5% home price appreciation. And look at the 90s. We started to see home values tick up again a little bit more, outperforming inflation throughout that decade. Now we know the 2000s were very different. Home prices performed at a very different rate than what we've seen in many other decades, and even what we're seeing today and potentially tomorrow. We also had a fundamentally different housing market. We had the oversupply of homes. We had lending standards that were vastly different than they are today. Homeowners didn't have the equity that they have in their homes right now. So fundamentally, a different market where we're not headed going forward. So home prices did not outperform inflation in the 2000s, but look at the 2010. This is where home values really started to kick in. Homes started appreciating much faster than inflation, 4.9% versus 1.8. And then 2020 and 21, you know what's happening here. Massive home price appreciation. You know, a drastic difference when home values outperform inflation. So over time, what can you see is that home ownership is generally looked at as this great hedge against inflation because home values are performing better than the inflation rate. That means that someone buying a home today can lock in those costs and protect themselves against the rising cost of inflation in that biggest monthly payment going forward. Now this becomes really important when we start to talk about renting, because renting takes on the risk of rising rental prices year after year after year. We've shown you that data if you've been following us, how rental prices are truly skyrocketing. So let me share a quote with you here that's really powerful for renters. It says, and this is from Bankrate, it says, a fixed rate mortgage allows you to maintain the biggest portion of housing expenses at the same payment amount. Sure, property taxes will rise and other expenses may creep up, but your monthly housing expense will remain the same. That's certainly not the case if you're renting, and that's because rental prices rise year after year. And so this becomes really powerful for someone who might be sitting here going, I could buy today, but I'm going to kind of just press pause and I'm going to wait. I'm going to wait and see what happens to home values, if they drop or rise. Well, all the forecasts that we have seen show that how home values are projected to continue to rise. We also know that mortgage rates are projected to keep rising, and we know that rental prices are rising. So what does that mean at the end of the day? Someone who continues to rent but could buy is taking on the additional increase in rent after year after year. Plus, it's going to cost more to buy a home down the road. So really important for renters to understand these dynamics, and I think this next visual really helps show how rental prices compare to inflation rate. This shows that rental increase has been greater than inflation in most years, so let me break it down again. Rental price appreciation versus core inflation rate, again going all the way back to the 1970s. So your blue line is that core inflation rate, and your green line is rental price appreciation. And what do we see as on a whole? The green line is higher than the blue line in most scenarios, meaning that the rental prices have increased at a faster rate than inflation in most years. Yes, there's some ticks down below that blue line. However, that means it's more expensive to rent over time because rental prices are continuing to rise faster than the rate of inflation. So when we have this conversation with renters, it becomes mission critical that they understand the dynamic of buying now if they can avoid those increasing costs for rent and inflation all around us. So let me go ahead and share this quote. I think this really kind of brings it home to us. It says, this is from Forbes, homeowners are shielded from mounting rental prices because their cost is fixed regardless of what happens in the market. They're locking in that payment at today's cost. Tangible assets like real estate get more valuable over time. We've seen that in the graph and the data that we've shown you, which makes buying a home a good way to spend your money during inflationary times. You know, we've talked a lot about home price appreciation, and I'm sure you want to know where is that headed as we have this conversation, and we think about rising prices and how homes aren't immune to that. So that's for certain. Let's take a look at this next graph from the Home Price Expectation Survey, and I think this gives you a home prices are projected to head according to the experts. Now, the Home Price Expectation Survey is a survey of 100 economists, data analysts, and people who are projecting out home price appreciations. And in the fourth quarter of last year, this is the projection for cumulative home appreciation by 2026. So what are you looking at? They divided out the group into optimists and pessimists. Optimists being the ones that projected the most appreciation over the next 5 years, and pessimists estimating on the lower side. So take a look at that orange bar. Those are the pessimists. We know the experts that are saying home price appreciation on the lower side, and even then, cumulatively by 2026, it's going to be over 23%. So as experts look forward, the conditions of the market, what's projected to happen? Home values are expected to increase in value over time, even on the lower end, 23%. 23.7 is pretty significant over the next 5 years. So locking in today's cost is mission critical for those who have the opportunity to do so, to protect themselves in the largest monthly payment, because as we know, with home prices rising, mortgage rates rising, inflation all around us, it is going to get. Let's shift gear and talk a little bit about mortgage rates, starting with a macro view. Here at the beginning of February, and certainly we've seen a rise in mortgage rates in a volatile environment. Sam Carter from Freddie Mac says, mortgage rates remain unchanged from last week. The economy lost momentum in January, leaving mortgage rates unchanged from last week and relatively flat for a third consecutive week. This stagnation reflects the economic impact of Omicron variant of COVID-19, which we believe will subside in the coming month. As economic recovery continues going into the spring and summer, mortgage rates are expected to resume their upward trajectory. In the meantime, recent data suggests that home buyer demand continues to be elevated as supply remains low, driving higher home prices. This statement came out the day before the job report on Friday, and certainly I think a positive job report hints to the Fed to take actions and raise the Fed's ground rate in March. So we are expecting to see rates going up. We are at about 3.55% on the average 30-year fixed recorded by Freddie Mac. But no doubt a volatile January leading into a February will see more rise in rates, and that's what we need to be prepared for. So if we look at this rise in rates, we are at about 3.55. This graphic shows back to the beginning of 2020, and we're starting to get back into the area. We're back in the area where we started when the pandemic came on us in March of 2020. Just to put that in perspective, the Fed comes in and acts and had the influence. They don't control mortgage rates, but they influence the rates down. And now we're back, coming back up. Certainly a sign that we're all hoping for, that the economy is improving, that we're getting through this, and we're moving ahead, but may start to work against buyers. If we go back to the beginning of 2018, which is what the graphic shows, on the average 30-year fixed, and sort of make this a line of 3.55%, you can see where we sit there, right? Certainly, we're higher back in 2018 and 2019, coming down and certainly dropped to historic lows during the pandemic, and we're starting to come back out of that. Perspective on that again from Freddie Mac. As mortgage rates rise, expect some moderation in housing demand, causing house price growth to temper. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level inventory of homes for sale should keep the housing market competitive. No doubt, we will see a housing market that is competitive this year. It goes on to say, in 2022, we expect purchase origination to grow from $1.9 trillion in 2021 to $2.1 trillion in 2022, while refinance activities is anticipated to decrease from 2.7 in 21 to 1.2 in 22. Why is this important? Look at the two mortgage markets, and you have purchase market, you have the refinance market. Purchase market forecast to grow, refinance market forecast to constrict. And that makes sense, right? In a rising rate environment, everybody had the chance, and there will still be refinance, but most people refinance at record low rate. And good for them as homeowners to be able to do that. Going to see the volume constriction. Why is this important right now? We're going to see headlines that talk about the overall mortgage market constriction, reducing or constricting. But the net effect in there is that purchase market is going to grow, refinance market is going to constrict, and let's keep that in perspective as we go in this year. And if you take this rate of 3.55 and even going to 4%, which I think we'll see very soon, that's still a very, very favorable rate when you go back all the way to the 70s. This is the average 30-year fixed by decade going 1970, 80, 90, 2000, 2010, and what do you see there at 3.55 or even at 4%? It's a very favorable financing when you look historically. So it's going to feel like we're heading higher But when we look back historically, it is still very, very good financing for homes across the country. So many rates have not seen on this opinion and will say, oh my gosh, we'll just wait and see. And here's what you need to be looking at for the rate conversation. When we started the year at about 3.1%, we're right now at 3.5, and we're going is, it's around that 4% mark. And I'm not saying we're going to stop at 4% because we don't have a crystal ball, but that's certainly the outlook. And let's take a loan amount of $900,000 for Bay Area, and we can take a look at the payment at 3.1, 3.5, and at 4%. And that's really going to show the people the real impact of rising interest rates. Let's move on to the next topic. The last one we have going to talk about today is the latest update that we have on forbearance. This is something that we've been following along for a while, and we'll share with you. And I think today's data is really going to help articulate why we will not see a wave of foreclosures coming to the market. Now, I want to begin today with an update on how many loans are in forbearance program. So take a look at this graph right here. You will see this with us before. Loans in forbearance have fallen below 1 million. This is massive. We are roughly at 780,000 loans in forbearance today, and that equates to only about 1.4% of mortgages. If you think about where we started over there in the red bars on the left, there were nearly 5 million homes in forbearance plan in May of 2020, and we're down to about 780,000. So huge progress, and just one more way that shows that the forbearance program has really helped homeowners change their situations, stay in their home, and really be in a better place than they would have been in such a time of economic uncertainty. And this is vastly different than what we saw in 2008. So I want to share a quote with you from Black Knight that says, as the COVID-19 pandemic continues to create uncertainty in the global economy, the overwhelming majority, 89% of single-family homeowners who sought financial assistance through COVID-related mortgage payment forbearance plans have exited those plans. So many people, 89% of the people who went into the forbearance plan have exited that. And that is massive improvement. What I want to share today is a graph that you have probably seen with us before, but this is loan upon exiting the forbearance program. I want to break this down because this really walks you through what's happening as people are exiting the program today. So take a look at the green section. Let's start there. 38.1% of homeowners exiting the forbearance plan are paid in full. So they've made their monthly payment or they paid off their loan. They've done something to bring their payment current, and they're in a great place. They're walking away, no issues. Now, 43.7% are workouts or repayment plans. That's the section in blue. This is the game-changing section. This is the section we didn't have the last time around when the housing bubble burst, because these are the homeowners who have been able to make a modification, a loan deferral, to go back to their bank and work with their bank or their lenders to change their situation and stay in their homes. This is huge, and what we've been saying over time is this blue section is getting a little bit bigger than the green section, and that's because more and more people have been able to go back and work out an alternate plan. That is massive. Now the percentage of homeowners that are still in trouble are in the orange section, 18.2%. But what does this mean is that these homeowners are exiting the plan without a loss mitigation plan. But on the safe side, what we know from Black Knight is that 93% of homeowners in forbearance plan have at least 10% equity. So when you have that equity, you also have the opportunity to potentially sell your home rather than going to forbearance. So people sitting in the situation, about 10% is kind of what tipping point of you could sell your house, you could pay off your fee, you could maybe even walk away with a little cash in your pocket if you sell your home. And so that gives someone a different opportunity than going to forbearance. We have a very strong equity situation across the country right now, enabling that opportunity. So as we look at this graph and we think about how many homeowners are exiting the plan, what's happening? The reality is that about 4 out of 5 homeowners are walking away just fine. Now, where I want to bring some additional context to this is in what the forbearance or what the foreclosure situation looks like in a typical year in the U.S. Because I think this really is going to start to shape up what we're talking about today versus what we had in 2008. Let me remind you, we shared with you the quote many times on how 9.3 million homes went into foreclosure the last time around when the housing bubble burst. And we are in a really different situation now. So remember that 9.3 as I walk you through this next slide. What this says here is that 422,000 fewer foreclosures over the last year. So we have significantly fewer foreclosures today than we would even in a normal year. Let me break it down for you. So look at those first 3 red bars, the taller ones on the left. That's 2017, 18, and 19. The number of foreclosures we had in those normal years leading up to the pandemic average just under 300,000. And so the unfortunate reality is that in this country, every year there are homeowners who do go into the foreclosure process. They have a job loss or a challenging financial situation. Something happens when homeowners have to give their homes back to their bank or their lender. In 2017 through 19, that number averaged out to about 290,000. Now, if you look at 2020 and 21, these were not normal years. This is where the forbearance program came into play, and there were far fewer foreclosures in each of these years. So if you look at the red bar under 2020, there were 120,000 foreclosure in 20, and that was short of 161,000 of what would be normal. 2021 through the third quarter is what we have data for right now, 29,000, so massively short. So that's where that 422,360 number comes from. And contextually, if you think about that, that's incredibly low. In fact, it is so low, I think this next graph really shows it well. Foreclosure activity is actually at an all-time low. So look at the number on the right side of the screen, 2021, where we are so far. There are 151,000 foreclosure filings. Now we never want anyone homeowner to go through the foreclosure process. We certainly don't want that to happen. We believe in home ownership and the value that it brings to everyone. But if you put this into context and you look at these red bars, 2007 to 15, millions of homeowners were going into the foreclosure process, and that is vastly different from where we are today. I mean, even in this number of 151,000, if it doubles, if it triples, if it quadruples, and it keeps going, we're nowhere near where we were when the housing bubble burst. And this is massively impactful, showing that the fundamentals of today's market are just very, very different today. Now, I want to end this with a quote because I think really kind of brings it home. This is from CoreLogic, and it says, "We may see a little bit of an uptick in foreclosure rates in 2022. Just an uptick though. from an extraordinarily low level. We're not expecting to see a big increase. We expect delinquency rates overall on home mortgages to actually continue to remain quite low. That's exactly where we are today. The numbers of homes going into the foreclosure process, nothing like we saw in the housing crisis, thanks to the forbearance program that gave homeowners the mortgage relief that they needed when they needed it most. So I'm going to end right here. Thank you so much for joining. And if you like this report, just click subscribe and make sure you follow us. And we'll be back with more of these market update reports. And we'll see you next time.